So, welcome everyone to session number 5 of Risk Explore. And the agenda for this session is portfolio optimization. Now, this topic is at the heart of any finance course, whether you take CFA, FRM, or CA. This topic you will find in almost all the finance courses, right? So, it is that much important. And today we will see that how we can practically do and apply all the concepts that we theoretically learn in books into Excel. Now we will step by step move and we will carry out the entire process, create the chart for efficient frontier and find out that what is the optimal asset weights that we must have in our portfolio. So सबसे पहले start करते हैं with the stock prices of these stocks. Let's say we have these three stocks in our portfolio, and for each of these stocks we would like to have the historical stock prices data. Now how to get that? One way is that we could go to Yahoo Finance, download each of them one by one. Other way is that we can use stock history function in Excel to fetch the stock prices, historical stock prices for each of these stocks. Now how can we do that? So let's do that here. Equals to stock history function. Again, stock history function you will find in either Office 365 or Office 2021, not in legacy Excel versions, the versions prior to that. So now we have to give the ticker symbol of the stock that we are trying to fetch data for. So the ticker symbol is, let's say, Reliance. So we can either type out Reliance or we can refer to Reliance from here as well. Reliance, comma, start date. Start date, let's say we want the data from year 2010, month 1 and day 1, 1st of January 2010. हमें वहां से डेटा चाहिए. Then end date, let's say we want all the stock prices, daily stock prices until today. So for dynamically giving the today's day, we have to use today function. So today, comma, interval, let's say we are interested in daily stock prices. So let's go with 0 here. Then do we want the headers or not? So let's say we opt for no headers here. Then we want properties. So the first property that we want is date. Let's go with date. And the second one, which is important, is the price. And we will go with closing prices. So let's type 1 here. Let's close the bracket, press enter. And we have the stock prices, historical stock prices for Reliance Industries from 4th of January 2010 until 10th of October 2025. So once we have this, we have the dates, we have the stock prices as well. What we can do is, let's copy the dates here, right? Let's copy the dates here. Now we have this for Reliance. Let's try this for some other stock, let's say Asian Paints. So this is the ticker symbol for Asian Paints, and we have this for Asian Paints as well. Now, one good practice to give the parameter for stock symbol inside the stock history function is that we also specify the exchange from which we are trying to fetch the stock prices data. So let's say we are trying to fetch this from NSE's website. So what we can do, we can use XNSE. This is the pattern that we have to give the parameter as XNSE colon double quotes and. So the symbol will become XNSE colon Asian Paint. Okay. Let's press enter. And these are the prices from NSE. Similarly, if we have to get it from BSE, we have to use BOM here instead of NSE. Let's press enter. So right now we are getting value error because on BSE, there are numbers allotted as ticker symbols for each of the stocks, right? So that's why we are getting value error, but otherwise this is the format in which we have to generate or pass the parameter for a stock here. So let's go back with XNSE and we have the stock prices. Now we have the dates already here for each of these stocks. So we already have dynamic dates here, what we can do is we can remove the dates property from here, and we only have the closing prices here now. So we have this. Now this is for Asian Paints. Let's try it for all the stocks dynamically. So let's do one thing. Let's select this from here. For date column as well, what we can do is let's say we opt for date property as well here. To dynamically generate the dates, what we can do is we can copy this formula. Let's come here. Let's paste that here. And since we only want the first column, we will use take function. So take only the first column, and we will dynamically get the dates as well. Otherwise, you can copy paste the dates as well. So we have the dynamic dates here. Then we have the stock prices of Reliance. If we drag this across, we will get the stock prices for all the other stocks as well. So for Reliance, for Asian Paint, and HDFC Bank, we have these three stocks in our portfolio. Now we have to find out the daily returns. Again, we have the dates generated here by referring to the date column here. We can use pound sign here as well to refer to this dynamic array. Now we have to find out the daily returns for each of these stocks. How do we do that? So for that, simply we can subtract from the current price, previous price, divided by the previous price, right? We have the returns here. Now, these are simple returns that we calculate, right? We can also calculate the log returns as well. For that, we will take natural log of this divided by this, and it will give us the log returns as well. Okay, we can drag it to the right and to the down as well, and we have daily returns for each of these stocks. Now, we will come to this later, portfolio return, but this is the information that we have here. Now, based on these returns, we will create the efficient frontier. So we have the log returns here. Now we have to compute. These are daily log returns, right? These are daily returns. Now we have to compute the returns on an annual basis. And similarly, we have to compute the standard deviation, which signifies the risk. So we have to compute mean returns, and we have to compute standard deviation of returns, but we have to compute annual mean and annual ST. So let's see how we can do that. So how do we compute annual mean? So for that, we will simply take average of daily returns. Let's say for Reliance, this is the average daily return for Reliance. Now what will be the annual return? How many trading days are there in an year? Correct, around 250. To be precise, there are 252 trading days. Yes. So this is the average return. Now mean is scaled by time, right? Mean is scaled by time, so we can multiply the annual average, daily average, with the number of days that we have in a year. So we have 252. Okay, 252. Now the problem with this is that this is not taking compounding into effect, right? So how do we take compounding into effect? Here we took log returns. So what we can do is we can use exponent here to take compounding into effect. So exponent of this, press enter. We have this. Now we have to subtract -1 from this. Okay. So after we take compounding, we get annual mean of Reliance Industries as 11.84%. 11.84%. Now let's drag it to right. So we have the annual return, annual average return for each of the three stocks that we have in our portfolio. Now similarly, we have to find out the SD as well, standard deviation. So how can we do that? equals to, there is a function in Excel called as standard deviation dot s, s for sample and p for population. So let's say we opt for dot s function, and now as the series we have to give this complete range for Reliance Industries return. Press enter and we have the daily SD of Reliance Industries. Now how do we find out the annual SD? We have to scale it by square root of time. Scale it by square root of times. So into square root of 252. Press enter and we have annual SD for Reliance Industries. Similarly for other stocks as well. Okay. So I hope it is clear until here. And now we will proceed with finding out portfolio mean and portfolio SD. What do we mean by this? Now we have these three stocks in our portfolio. So ऐसा जरूरी नहीं है कि वो तीनों इक्वल प्रोपोर्शन में होंगे हमारे पोर्टफोलियो में, राइट? कोई स्टॉक लेट्स से 20% है हमारे पोर्टफोलियो का, कोई स्टॉक 50% है, कोई 30% है, एंड सो ऑन, राइट? सो अकॉर्डिंगली वी हैव टू फाइंड आउट दैट पूरे पोर्टफोलियो का मीन रिटर्न्स क्या रहे होंगे, एंड पूरे पोर्टफोलियो का मीन एंड पूरे पोर्टफोलियो का स्टैंडर्ड डिविएशन क्या रहा होगा इन द पास्ट. So how do we do that? So for that we are assuming that we are investing 20% in Reliance Industries, 50% in Asian Paints and HDFC Bank में हमने 30% इन्वेस्ट किया है. So how do we find portfolio mean? For that simply what we can do, we can take a weighted average. For taking weighted average we can use some product function. So we can take weighted average of the weights here and the annual mean, annual historical mean. Let's close the bracket, press enter, and we have that here. Other way to do this is, if you have Office 2021 or 365, other way to do that is equals to, simply we can multiply the weights by the annual mean of each of the individual stocks, and इस पूरे का हमें sum लेना है, sum of this resultant array. So we are getting the same answer. So हमें portfolio mean मिल गया. Now how do we find out portfolio SD? How do we find out portfolio SD? So there are multiple ways to do this, right? There are multiple ways. You can see that this is the formula for finding out portfolio SD if there are more than one assets, more than two assets. We will come to that. We will come to covariance, but let me show you other ways as well. So without knowing covariance, how can we do that? So if you see this, this is the formula for portfolio SD. If you have multiple assets, if you have only two assets, only two stocks in the portfolio, then this is the formula. This is simpler formula. But right now, since we have more than two assets, two stocks, so we will use this formula here. Okay. We will have to use this formula here. Now, how do we find portfolio SD? So there are multiple ways to do this. Let's assume that these are the weights that we are using here. So we can find out the daily portfolio returns as well, right? We can find out that as well. So equals to sum product of these returns, comma, the weights here, and we have to fix the weights. So हमने weights को fix कर दिया. Press enter. We have the daily portfolio returns कि portfolio का daily basis पे क्या return है, right? Now if we drag this down, since dragging will not be an optimal way, so what we can do is we can select this complete series, press tab key to move to this cell, press shift and right arrow key to select this range, press F2 key so that we can see the formula in editable format, and press Control plus enter. So we have populated the formula for all the rows. Let me do this again. So यहाँ पर हमने क्या formula लगाया? equals to sum product to calculate the daily portfolio return. Sum product of daily returns for these stocks, comma, the weights. Now ये weights हमें static रखने हैं for all the days. So for that we will use F4 key to fix the references here. Close the bracket, press enter, and we have the daily portfolio return. And to do this for all of them, we can press F2 key, we can press tab key, shift right arrow key, F2 and control enter. Okay, so we have the daily portfolio returns. Now, how do we find the portfolio SD? So simply we can use equals to standard deviation of these portfolio returns here. Okay, press enter and we have the daily SD. Now to convert this into equivalent annual SD, we have to multiply this by square root of 252. We have this number here. Okay, we have this number here. Now how do we find out using this formula here? How do we do that? So if you see what this formula says is that हमें हर एक combination of assets के लिए, let's say we have to pair Reliance with Asian Paints with HDFC Bank with itself as well, then हमें Asian Paints को pair करना है with Reliance Industries, Asian Paints, HDFC Bank. So हमें हर एक stock को we have to pair it with each other, right? We have to pair it with each other and then हमें उसके respective weights को multiply करना है with their covariance. So if you see this term, correlation into SDI and SDJ, this is nothing but covariance. So हमें क्या करना है, हमें pair wise we have to compute covariance here. We have to pair wise compute covariance. Covariance का क्या formula है? Equals to, we have a function for that, equals to covariance. We will go with covariance.s. Now since we are finding out covariance between Reliance and Reliance, so what we will do, we will select this comma, again this complete range. Okay, so we have covariance here. Yes, you can use data analysis as well, but this will be dynamic. Data analysis tool pack will not be dynamic. If you change the asset here, you will have to carry out the entire process again. So we have the covariance. Now the point is that how do we find out, how do we make this thing dynamic such that it is dependent on these selections here. कि हमें रिलायंस और रिलायंस के बीच में कोवेरियंस निकालना है, रिलायंस एंड एशियन पेंट्स के बीच में कोवेरियंस निकालना है. सो हाउ डू वी डू दैट? So for that we can simply use x lookup function. Let's say we want to look up for Asian Paints. हमें Asian Paints के returns चाहिए, daily returns चाहिए. Where do we have to look up? We have to look up here. We have to fix this, right? Comma. हमें return में क्या चाहिए? In return we want the returns range. Press F4 key to fix this as well. And we have the daily returns for, let's say, Asian Paints. Now, similarly, similar to Asian Paints, can we also find out daily returns for Reliance Industries? So we will shift the selection to Reliance Industries, and we have the daily returns for Reliance Industries here, right? So this is how we can dynamically fetch the returns here. So what we can do, instead of manually referring to the range here, we can copy this formula and come back here, paste this here. Now we are looking up for Reliance Industries here, and we have to fix the column here. Okay, comma. Similarly, along with it, we are trying to pair Reliance Industries from top here. So we will select this, press F4 key to fix the row. Once we have that, press enter. We can now simply drag it across and drag it down. So we have dynamically generated covariance matrix, variance covariance matrix for each of the pairs of stocks. Okay, if you see, we have it between HDFC Bank and HDFC Bank. So if you see the diagonal diagonal numbers here, these are nothing but the variance of each of these stocks. Okay, these are the variances of each of these stocks, and let's say this is the dynamic um, covariance between Asian Paints and Reliance Industries. So covariance, once we have the covariance, what we can do is we can try out this formula here. So how do we do that? Equals to, we have to multiply the covariance matrix here with the respective weights here. So हम रिलायंस को मल्टीप्लाई, रिलायंस एंड एशियन पेंट्स एंड एचडीएफसी बैंक, उसके वेट्स को मल्टीप्लाई कर रहे हैं विद द वेट ऑफ रिलायंस इंडस्ट्रीज. सिमिलरली हम तीनों स्टॉक्स को मल्टीप्लाई कर रहे हैं विद द वेट्स ऑफ एशियन पेंट्स एंड तीनों स्टॉक्स के कोवेरियंस को मल्टीप्लाई कर रहे हैं विद द वेट्स ऑफ एचडीएफसी बैंक, राइट. सो वी हैव दैट हियर, वी हैव द सम वी हैव द प्रोडक्ट हियर. नाउ हमें रो वाइज वी हैव टू ऐड देम टुगेदर. Row wise we have to add them together. So for that we can use by row function, by row comma row wise हमें क्या करना है, sum करना है. So we can use the sum function here. Close the bracket, press enter. We have the row by row sum here. Then we can transpose this. We can transpose this. We have the transposed version here. Now इस transposed version को हमें multiply करना है with the weights. Once we have this, we can simply use sum function to get the variance. We have the variance here. Now we have to use square root here to get the SD, and we have to multiply this by square root of 252 to get annual SD. Okay, this is one way. Let me show you other way as well, and then we will again revisit this. Other way is using matrix multiplication operations. Matrix multiplication. So what we can do is we can use mul function to find out matrix multiplication between this and the covariance matrix, between the weights and the covariance matrix. We have that here, right? We have the matrix multiplication. Now we have to again do mult here with the transposed weights range, and we have this number here. So we have the mult again here. Now we have to find the square root of this. We have this, and we can also do one thing. Instead of later on multiplying it by square root of time, we can directly multiply by 252 inside the square root, and we will simply get the same result. So we have we have figured out, or we have computed portfolio SD in 3 different ways, and each of them is yielding the same result. Now what we have to do, we have to generate some random weights for each of these stocks. We have portfolio mean, we have portfolio SD. Now our next task is we have to generate random weights for each of these stocks. Yeah, sure. Like I can do that. Equals to formula text. So we have the formula here. Okay, you can refer to the formula from here. We can copy paste special this as well, right? Now this is one of the portfolios. ये हमारा एक ऐसा पोर्टफोलियो है जिसमें हमने वेट्स रिलायंस का लिया है 20%, एशियन पेंट्स का लिया है 50% एंड एचडीएफसी बैंक का हमने लिया है 30%. देयर कैन बी n number of possible portfolios that we can create, right? We can take n number of possible weights. Do you agree? लेट्स से हमने रिलायंस का वेट 0% कर दिया, एशियन पेंट्स का भी 0 कर दिया, एंड 100% हमने एचडीएफसी बैंक में इन्वेस्ट कर दिया. सो दैट इज ऑब्वियसली पॉसिबल. सो हमें रैंडमली इसी तरीके से वी हैव टू जनरेट ऑल द, नॉट ऑल बट मोस्ट ऑफ द पॉसिबल वेट्स. जितने भी हम पॉसिबल वेट्स जनरेट कर सकते हैं, वी विल डू दैट. वी विल जनरेट द पॉसिबल वेट्स एंड वी विल डू इट रैंडमली. हम रैंडमली वेट्स को जनरेट करेंगे. लेट्स से हम ऐसे इसी तरीके से लेट्स से वी क्रिएट 10,000 रैंडम पोर्टफोलियोज, 10,000 रैंडम पोर्टफोलियोज विथ रैंडम वेट्स. तो वो कैसे कर सकते हैं हम? वी कैन यूज rand array function for that. We can use rand array function for that. For that, simply what we will do, we will, and also in that we have to ensure one property. What is that property? If we see, the sum of these three has to be 100%. राइट, बिलो 100% नहीं चलेगा, बिकॉज वी आर अज्यूमिंग दैट हम एंटायरली जो भी पोर्टफोलियो है इट इज कंपोज्ड ऑफ ओनली दीज थ्री स्टॉक्स. तो हमें 100% वी हैव टू इन्वेस्ट इन दीज थ्री स्टॉक्स. सो अगर हमें रैंडमली जनरेट करना है, लेट्स से 10,000 वेट्स, so equals to we can use rand array function. And first of all, instead of focusing on weights, let's just only generate 10,000 random numbers, 10,000 and 10,000 rows of random numbers and 3 columns as well for each of the 3 stocks. So 10,000 comma 3, since we have 3 stocks in our portfolio. So we have random numbers here. These are nothing but random numbers. So let me change the formatting. These are nothing but random numbers here. If I press F9 key, you can see that these are changing. Okay. Now, how do we derive the weights? How do we derive the weights? So we can do that. If you see, ये इसका सम है, राइट? इसका सम क्या आ रहा है? 2.42%. इसका सम क्या आ रहा है? 2.42%. इसका सम आ रहा है 2.42. इसका सम आ रहा है 2.42. यू कैन सी एट द बॉटम हियर. नाउ अगर आप इस 2.42 में से हर एक का वेट ले लेंगे, सो यू कैन डिराइव रैंडम वेट्स एज वेल, राइट? सो व्हाट वी कैन डू, if we let's say do this here, equals to this divided by sum of the entire row. So आपको क्या मिल गया यहाँ पर? एक कुछ वेट मिल गया. एंड इफ यू फिक्स दिस रो हियर, यू ड्रैग इट अक्रॉस, सो आपको रैंडमली वेट्स मिल रहे हैं. यू आर गेटिंग रैंडम वेट्स हियर, जिसका सम क्या होना चाहिए? 100% होना चाहिए, एंड वी हैव द सम एज 100%. So simply what we are doing, we are generating 10,000 random numbers. Then for each of the rows, we are taking the weights of those random numbers. And उनका हम weight ले रहे हैं, तो जो हम weight portfolio का रखना चाहते थे, that is also random. If we press F9 key, you can see, since random numbers are changing, उनका weight भी change हो रहा है respective rows के sum में, and likewise उनका हर एक stock का weight is also changing in the portfolio. Okay. Now we have to do this exercise dynamically. How do we do that? So for that, again, these are some advanced operations. You can refer to the formulas directly. So let's say we assume that we are giving this random array the name as A, comma, what we are trying to do, A divided by sum of each of the rows. So each of the rows का हमें sum लेना है, and जो भी हमें रैंडम नंबर्स मिले हैं उससे डिवाइड करना है बाय द सम ऑफ ईच ऑफ द रोज. सो बाय रो ए कॉमा सम. इफ यू डू दैट एंड इफ यू चेंज द फॉर्मेटिंग, you can see that we have generated 10,000 random portfolios with different weights. If you press F9 key, you can see the weights are changing. So हमें 10,000 ऐसे random portfolios मिल गए जिनका weight 100% है, total weight 100% है, and we have random allocations to each of the 3 stocks. Now once we have the random weights for each of these portfolios, can we compute portfolio SD and portfolio mean as well? Similar to what we did here. यहाँ पर भी हमने using these weights we computed portfolio mean and portfolio SD right? Can we do the same thing here as well? Can we do the same thing here as well for each of these individual random portfolios? It's kind of simulation only. We are simulating 10,000 different portfolios, but like this is the way you can generate random weights for each of the portfolios such that their sum is 100%. Okay, so how do we get portfolio SD using these weights here? Simply what we can do, let's say we have to find out portfolio SD, so we can like use this formula here. Let's use this formula directly here, paste this here. Now instead of using these weights here, we will refer to the weights given here, right? And similarly, instead of using this static weight, we will refer to these weights here. Press enter, and we have portfolio SD for this portfolio, right? Portfolio with these weights. Similarly, if we, let's say, drag this down, so we cannot directly drag this down. We have to fix few references as well here. So हमें क्या fix करना है? We have to fix the covariance matrix here. Covariance matrix को हमने fix किया, and now if we drag this down, you can see that we have random portfolio SD as well. Random portfolio SDs as well. Now, is there a way such that we don't have to drag this formula down and dynamically get the results? Yes, we can do that. For that, we can use by row function. By row, select this array, right? इस array के लिए हमें हर row के लिए क्या operation perform करना है? So for this array, we have to perform a particular operation. Let's use lambda function here, and let's say we refer to each of the rows as x. We refer to each of the rows as x, and now यहाँ पर instead of referring to this row statically here, we will say that this is x, and similarly we will say that this is x here. Close the brackets, and we have portfolio SD for each of the rows, for each of the portfolios here. Okay, and what is the benefit of this? Let's say you go ahead tomorrow and you say that, okay, I don't want to do 10,000 simulations, I only want to do 1,000 simulations. So if you write 1,000 here instead of 10,000, if you go down, you can see that ये dynamically ये भी change हुआ आपका, just because you have done everything using dynamic arrays. Okay, so this is how we can make this dynamic. We have dynamically generated 1,000 simulations for portfolio SD, and let's make it 10,000 simulations. Now similarly, we can find out portfolio mean as well. What was the formula for portfolio mean? This is the formula. So let's copy this, let's come here, paste that here. Instead of using these static weights, we will refer to these weights here. Press enter. We have this. Now we have to again use by row in a similar fashion, comma, lambda x, comma, we instead of referring to these weights here, we have to refer to x. Close the brackets, press enter, and we have portfolio means for each of these randomly generated portfolios. Now, what happens if we plot these two together? Portfolio SD and portfolio mean of randomly generated portfolios. Go to home, insert tab, recommended charts, and go to scatter plot. You can see this kind of plot here. So we have this here, and this is nothing but all the possible combination of portfolios that we can create using these assumptions here, right? Assumptions of annual mean and annual SD. Again, just to clarify one point, this is computed using historical data, right? This is computed using historical data, but we cannot like say that historical data will be representative of the future as well. So you can use your own numbers as well here. Using your research, let's say using your research, you find out that Asian Paints will not perform this well. It will not give us annual return of 18%. It will only give annual return of 5%. So you can use 5% here instead of 18%, right? So that is something that we can manage here. But otherwise, This is the these are the randomly generated values, right? Combinations of portfolio SD and portfolio mean for these three assets. And if we press F9 key, you can see that this is random simulation here, 10,000 simulations. And what we can do is further that we can reduce the size of the marker here. Let's use no border here, and let's fill it with um, this color here, right? And let's increase the transparency to 50%. Okay, so you can see that these are all the possible portfolios, all the feasible portfolios that we can create. And if you see in the textbooks as well, this is the kind of diagram you will see for um, all the possible portfolios that we can create, right? And this is how you create it. F9, if you press F9 key, you can see that this is changing. So this is one part. These are all the possible portfolios that we can create. But can we say that all of these portfolios are actually feasible or actually good for us? We would create in real life? The answer is no. Why the answer is no? We discussed earlier that um, SD stands for risk. SD means risk, right? So if you see here, let's say we take this line as now, if you see this diagram, not all the portfolios are optimal to invest, right? Not all the portfolios are good for us to invest. How do we say that? If you see this point here, 20%, 20% SD. So on the x-axis you have SD, on the y-axis you have mean. Let's do that as well. Let's add access titles and let's add here portfolio SD, and this is portfolio mean. Okay, we have portfolio SD and we have portfolio mean. Correct. This is Markowitz umbrella, and this is how you dynamically create in Excel. Okay. So we have this. We have SD here. We have portfolio mean here. If you see 20% here, now on 20% for 20% SD, you can either earn this return here, right? You can earn 14% return here. Similarly, you can also earn a higher return as well for the same SD, which is 17.58%. So in real life, will you any day opt for a lower return for the same SD for the same risk? सेम रिस्क के लिए क्या आप कम रिटर्न में सेटिस्फाई, क्या आप कम रिटर्न को ऑप्ट करेंगे? नेवर, राइट? नेवर. What we will opt for is this return here, right? We will opt for this um, portfolio here, right? For the same SD. Correct. So that means there are some efficient portfolios. There are some efficient portfolios that we will only opt for in certain scenarios. So for finding out the global minimum variance portfolio, what does this mean? That below this point, we will not opt for those portfolios on this frontier. So ये सभी possible portfolios हैं. इसमें से भी कुछ ऐसे portfolios हैं जिनको हम कभी भी नहीं choose करेंगे, जिनको हम कभी भी choose नहीं करेंगे, right? So how to filter out for those portfolios? What we can do is we can find out global minimum variance portfolio such that our portfolio SD is minimized. हम मिनिमम पोर्टफोलियो एसडी को फाइंड आउट करेंगे. ओके, सो हाउ डू वी डू दैट? सो फॉर दैट वी कैन again similarly find out portfolio SD using these weights here. We have assumed these weights, and if we have to find out the portfolio SD, we can use the same formula that we derived here as well. So let's copy this, right? Let's copy this, and instead of, okay, not this one because this doesn't directly uses weights. Let's use this formula here for now. Let's use this. Let's come here paste that here. Now, instead of referring to these weights here, we will refer to these weights and these weights here. So we have the portfolio SD. Now, portfolio mean, similarly, we will copy this formula and we will find out portfolio mean using these weights now, using these weights here. Press enter, we have the portfolio mean here. Now, what we have to do, we have to find out these weights such that the standard deviation of the portfolio is minimized. Now, how do we do that? For that, we will use solver. So we will go to data tab and here we will select solver. Let me reset all the parameters here and let me close this. And if in case you don't have solver, so what you can do is you can go to file, options, right, add-ins, go down and you have to select Excel add-ins here, click on go, and from here you have to pick this option of solver add-in, click on OK, and once you do that, you will have solver enabled here. Click on solver. Now what we have to do, we have to minimize the SD here. We have to minimize the SD here by changing which values, by changing the weights here. So we have to find out the weights such that the SD of the portfolio is minimum, and we have to make the we have to take the weights as non-negative values. So let's click on solve, click on OK. So right now what we are getting is we are getting 0% for each of. वो कहना चाह रहा है कि आप इन्वेस्ट ही मत करो, अगर आपको इतना डर लग रहा है, don't invest. So to resolve this issue, what we can do is we can take the sum of these weights as well, and we will make sure that the sum of these weights, the amount we are invested is 100%. So what we will do is we will again go here and add a constraint here. Constraint क्या होगा हमारा? That the total of weights should be equal to 100%. Let's click on OK. And now let's click on solve. So solver has found out the weight such that we have the minimum portfolio SD. So this is the combination for which we have the minimum portfolio SD, and this is the mean for that, right? This is the mean for that. So now there is one more way in which we can find out the portfolio SD and portfolio mean without using solver, right? Minimum portfolio SD, and to do that we can use minimum function, and since we have all the possible portfolios here, we can find out the minimum SD here. And minimum SD, if you see, these numbers are coming close enough. If you, let's say, decrease the number of simulations, let's say if you do only 100 simulations, then there would be some differences in these values, but as you increase the number of simulations, you will get closer and closer answers, right, without using solver. So let's switch back to 10,000 simulations. We have almost similar portfolio SD such that it is minimum. And how do you find out portfolio mean without relying on solver? We can use equals to X lookup for this in here, right, in here, and find out the portfolio mean. So we have approximately similar portfolio mean, right? So we have the minimum portfolio SD, and like for this, from these portfolios, this is the SD, and for that minimum return that we would need is 16.28%. After that, after this point, what we have to do is we have to basically increase the SD in order to increase the portfolio mean. But for all the other combinations that are below this point, we can say that they are inefficient. Why? Because for them, higher SD is giving us lower mean. Okay. So once we have the global minimum variance portfolio, we can plot this as well, right? We can plot this as well. Yes, you will see this in chart. This like you can also see that this point somewhere exists on the chart, right? Because it is derived from these combinations only. So you will see that this point will exist on the chart since we have done 10,000 simulations. We have done so many simulations. So let's plot this as well. So let's select this chart, select data, add, let's name this as GMVP. Uh, X point will be this value, and on the Y axis, we will have this value here. Click on OK, click on OK, and we have the global minimum variance portfolio lying somewhere here. Below this point, all the portfolios are inefficient. Right, below this point, all the portfolios are inefficient. Above this point, right, above this point, we can say that those are the portfolios that are worthy investing in, that are worthy investing in, right? So now let's find out the efficient frontier as well. Let's plot the efficient frontier. How do we do that? So equals to, we will say that if the portfolio mean, if the portfolio mean is greater than, or we will say if it is less than this portfolio mean, then that is not part of our efficient frontier, right? So we will get any error here. Otherwise, we will say that we want the SD back. So we have this here. Now let's copy the same formula, apply it here. And instead of SD, now we want mean back. Press enter. Now we have the mean back. Now this is the efficient frontier that we are talking about. So let's select this chart again, go to chart design, select data, add, and let's name this series as efficient frontier. As X, we will use these values. As Y, we will plot the portfolio mean, right? Click on OK, click on OK, and we have the efficient frontier. We are not able to see it right now, but for getting that, we can like go to Format tab, Efficient Frontier, and we have to change the selection here. So instead of referring to just P9, we can select this complete range, and instead of referring to just this cell, we can select this range here, and this will be this reference here. Now if we see, we have the efficient frontier plotted here as well, and we can go to markers, reduce the size of this. Let's use a different color. Let's use this color here. We don't want any border lines, and let's make this 50% transparent. Okay, now we have this. Also, like we are not able to see this point, the global minimum variance point. So what we can do is we can go to select data and move this up. So we have this here, right? We have this here. This is how we can like plot efficient frontier and all the possible portfolios that we have in the data. So now once we have this, we can also find out the optimal portfolio. What are the optimal weights such that our risk weighted return is maximized? Our risk weighted return is maximized. हम जितना रिस्क ले रहे हैं उसके अगेंस्ट में वी आर गेटिंग द मैक्सिमम वैल्यू, वी आर गेटिंग द मैक्सिमम रिटर्न. So how do we do that? What is the indicator that we can use to, what is the metric that we can use to derive risk weighted return? If anyone can tell in the chat section, what is the metric that we can use? If you have studied in CFA level 1 or FRM, we can use Sharpe ratio. Correct, we can use Sharpe ratio. Now what is the formula for Sharpe ratio? What is the formula for Sharpe ratio? Correct, it is excess return divided by SD. Excess return divided by SD. So return of portfolio minus RF minus risk-free rate divided by SD. So how do we find out portfolio SD? We can like copy the same formula here, and instead of using these weights, we will refer to these weights here. And similarly, instead of referring to these weights, we can refer to these weights here. So we have the portfolio SD, assuming that these are the weights that we use. Similarly, we will find out portfolio mean as well. Copy this and portfolio mean. So for portfolio mean, we will refer to these weights now, right? This is the portfolio mean assuming these weights. RFR, let's assume we have RFR 10-year GSEC yield as 6%. Okay, let's assume this as 6%. Now, how do we find out Sharpe ratio? Equals to, within brackets, portfolio mean minus RFR divided by portfolio SD. So we have Sharpe ratio here. Now, what we have to do in order to find out optimal portfolio? We have to maximize this Sharpe ratio. Okay. How do we do that? We can go to data tab, solver, right? Instead of minimum, we have to maximize. What we have to maximize? We have to maximize Sharpe ratio here by changing the weights here, right? By changing the weights here. And constraint will be the same constraint, that the sum of these weights should be 100%. Okay, let me refer this again. It should be 100%. Let's solve for this. And we have these weights. So these are the optimal weights that we should have if we have to maximize the Sharpe ratio. So this is the optimal portfolio, and for that optimal portfolio, this is the SD and this is the mean, right? And now if we have to do this from the simulations itself without relying on solver, what we can do, we can find out Sharpe ratio for each of these combination of SD and mean. So we can do this equals to the complete range of SD, the complete range of portfolio mean minus the risk-free rate divided by portfolio SD. If we see this, this is the Sharpe ratio, right? This is the Sharpe ratio. We can apply the formatting as well. Yes. So this is the Sharpe ratio that we have here. And just give me a second. What we can do is we can find out the maximum Sharpe ratio that we have in this. So what is the maximum Sharpe ratio that we have here? You can see that they are very close to each other. As we increase the number of simulations, they will almost become equal, right? So without relying on solver as well, we can find out based on the simulations that this is the maximum Sharpe ratio. And against this, what are the weights? So for that, we will use equals to X lookup this in here and give me the weights here. So these are the optimal weights based on the simulations that we did, right? Is it making sense? You can see that they are almost similar. This was using solver and this was purely based on simulations, right? Close enough. Yes. Now same way we can find out their SD and portfolio mean as well, right? So once we have the optimal portfolio, we can plot that optimal portfolio as well here. So we can like go to chart design, select data, add, and we can add the optimal portfolio as well. X will be portfolio SD and Y will be portfolio mean. Okay and okay. So we have optimal portfolio lying somewhere here in the entire series, right? And we can change its color as well. So we can go to marker. We don't want any line, solid fill, and let's say we give it this color. So this is the optimal portfolio that we have here. Now for this optimal portfolio, like this is the SD that we will have, right? We are constrained, we have this constraint कि अगर हमें optimal portfolio में invest करना है, then this is the SD, minimum SD that you will have to have here. What if you want to increase the returns or the SD, right? How we can do that? अगर हमें let's say risk को कम करना है, तो same way हमारे returns भी कम होंगे, but how do we manage the risk here? How do we change it? So to change it, what we can do is we can introduce a risk-free asset as well to our portfolio. Risk-free asset to our portfolio. Now risk-free asset को अगर हम introduce करते हैं, so उसका we already have the return कि अगर risk-free asset में हम invest करेंगे, so we will earn 6% from it. And उसका standard deviation क्या होता है risk-free asset का? If we are saying it is risk-free, so उसका standard deviation या risk उसका कितना होगा? It will be 0, right? It will be 0. Correct, it will be 0. So what we will do is we will introduce a risk free asset and उसका भी हम कुछ weight लेंगे अपने portfolio में. ठीक है, we will introduce a risk free asset, उसका कुछ weight लेंगे, and likewise we will have some weight for risky asset as well, right? If you see, this is the risky portfolio. When we are investing in these stocks, this is risky portfolio. So how do we randomly assign weights? So again, for that we will simply use rand array function here. Rand array of, let's say we do 10,000 simulations again. So we have 10,000 random weights given to risk-free asset. Now similarly, what will be the weight given to risky asset? It will be 1 minus weights given to risk-free asset. So we have the weights for risk-free asset and the risky asset. Now if we have to find out the portfolio SD for which combines the risk-free asset and the risky asset, how can we do that? If we have to combine these two together, how can we do that to find out the portfolio SD? So we can refer to this formula here. Formula for two asset portfolio. If we have to find out the SD for that, we can see here that it is square root of weight 1 square sigma 1 square. So let's assume sigma 1 is the asset number 1 is risk free asset. So risk free asset ka hamara what was the SD? It is 0, right? So this component here, let me draw here. So if you see this component here, this will become 0 because SD of risk free asset is 0, right? So this component will become 0. We can cancel this out. Now similarly, if we check this out here, the covariance, if we like not look at covariance, if we look at this formula here, correlation into SD1 into SD2. So SD1 is 0, so this component will become 0, and similarly this component will become 0, right? So what we are left with is square root of weight 2 square, that is weight of the risky asset, multiplied by variance of the risky asset, and we are taking square root of that. So if we have to find out portfolio SD combining risk-free asset and the risky asset, it is simply weight of risky asset multiplied by SD of the risky asset. SD of the risky asset, right? So what can we do now? What can we do now? In order to find out portfolio SD, we can simply multiply the weights of risky asset by the SD that we computed here, right? Portfolio SD of risky assets for each of the 10,000 simulations, we get the portfolio SD here. right? Similarly, what will be the mean? What will be the mean? It will be equals to weight of risk free asset multiplied by 6% plus weight of risky asset multiplied by the mean returns that we have here for each of the risky assets. Correct? Yes, correct. Correct. So let me, um, yeah. Right. So we have portfolio mean and we have portfolio mean here, right? In which we found out the uh, weighted average return of the portfolio by combining risk-free asset, multiplying risk-free asset with 6% rate that we are earning and risky asset के लिए हमारे पास ये returns थे. So this gives us all the feasible portfolios with risk-free borrowing and lending, right? Risk-free borrowing and lending. Right now we have only considered positive weights here, but we can also have negative weights for risk-free portfolio as well. Okay, so risk free asset में negative weights का मतलब क्या हो गया? We can leverage our position in risky portfolio. Let's say you are assuming that okay, I have to increase my SD. I have to increase my SD, so you can borrow at risk free rate as well and then invest in your risky asset. So that way we can have negative weights to given to risk free asset as well, right? We will borrow. Yes. So we have the portfolio mean. Now we have to find out the capital allocation line. But before that, let's plot all these feasible portfolios here in this chart. So let's go to chart design tab, select data, add, and let's name this as feasible portfolio with RFR. And our X will be this range here, and our Y will be this range here. Okay. Okay, and okay. So we have this. Now this is not correctly populated. So what we can do is, like this is a bug in Excel. We will refer to this range here, and this goes only until 10018 row. Press enter, and if we see here, we have this populated here. This seems bit off. Okay. Let us try to investigate. Okay, sharp ratio in SD. Okay, I think I did some mistake there. Yeah, correct, correct. Thanks for correcting. This will be portfolio ST instead. So now we have the correct number for portfolio ST. Thanks everyone for correcting this. So now we have all the feasible portfolios here combining risk-free rate with risky portfolio. And now let's do one thing. Let's go to chart design tab again, and let's move this up here so that we can see the other things being plotted as well. So let's press Control 1 in order to edit this. Let's change its color. We don't want any line. If we go to marker section, we want built-in marker. Let's use this kind of marker here, and let's reduce its size to let's say 1. And we don't want any border. We want solid fill, and let's say we want this color here being used for all the feasible portfolios. So we have all the feasible portfolios. Now let's also try one more thing, that instead of just using values between 0 and 1, giving only positive weights to this risk-free asset, what we can do is we can give it, let's say, minimum -1. We can give it a weight of -100% as well, and maximum as, let's say, 1. Okay, let's press enter. You can see that these are the feasible portfolios that we can have, right? Let's switch back just for better visibility. Okay, so we have this. Now you can see that it is not greater than, it is never greater than this tangent line to the optimal portfolio. You can see that there is a tangent line going through this optimal portfolio, and below that we have all the possible feasible portfolios that we can create. But ideally we would never create a portfolio of risk free asset and the risky asset that is below this tangent line going through the optimal portfolio, right? Because again, there, for any SD we will earn a lesser return, right? We will earn a lesser return. So what we can do is we can find out a line and plot that here such that it is tangent to this optimal portfolio, which we can observe through the chart as well here. So let's plot that here. So what will be the SD of that line? It will be same SD here. It will be same SD here. SD we will keep it same. Now to get the portfolio mean, if you see what is the formula for Sharpe ratio? Formula for Sharpe ratio is mean return minus risk free rate divided by SD. So we have the SD, right? We have risk free rate. We have to find out portfolio return, and we also have the optimal Sharpe ratio as well. So we have the optimal Sharpe ratio. What we can do is we can like reverse the equation. So let me draw that out. What we have here right now, Sharpe ratio, right? If we shift everything to left with Sharpe ratio, what we will be left with is RP, right? So what we have to do, basically we have to take Sharpe ratio, optimal Sharpe ratio, multiplied by portfolio SD, right? And add the risk free rate to this. So we have the mean for the capital allocation line, right? What we will do now, we will plot this line here on this chart. Go to chart design, select data, add, let's name this as CAL. This will be portfolio SD, and this will be portfolio mean. Okay, okay. And you can see that this is the capital allocation line, optimal mix of risky and risk free asset which we must follow, and every point on this line will have the same Sharpe ratio. Okay, optimal Sharpe ratio. Let's adjust this. So instead of markers, let's go with lines, solid line, and let's color this with let's have this as the color for this line, and let's reduce the width for this line. So we have the capital allocation line plotted as well. We have capital allocation line, we have optimal portfolio, and on this capital allocation line you can see that you can increase or decrease the portfolio SD beyond this point here, right? Beyond this point of tangency, right? You can increase the SD to increase the return, or you can decrease the SD to decrease the return as well. Okay, so this is how we can practically optimize our portfolio and compute this capital allocation line for optimal allocation into risk-free asset and risky assets.